Welcome all learners. I am Dr. Gitanjali Bhatt Sharma from Uttarakhand Open University, working as an assistant professor in the Department of Management Studies and Commerce. Today we will learn the concept of overview of debt securities. As you all know, in the last lecture you learned about market indices Nifty and Sensex, where we learned that Nifty and Sensex are the key stock market indices in India, which reflect the performance of top companies listed on National Stock Exchange as well as Bombay Stock Exchange. And even they serve as a barometers of market trends, investors, and to the overall economic outlook. In this lecture, the topics we will cover here are introduction of debt securities, features of debt securities, what are the types of debt securities, benefits of investing in debt securities, and who are the participants in the debt market. So first of all, starting with the meaning of debt securities. So debt securities are the financial instruments which are issued by government corporations or other entities to raise capital, as these instruments serve as a form of borrowing where the issuers promise to pay the borrowed amount along with interest at a future date. Investors who purchase debt securities are essentially lenders receiving a very regular interest payment over the life of the security and return of the principal upon maturity. So, in simple word, debt securities play a very critical role in financial market by providing a stable investment option for investors and a reliable source of funding for issuers. They are generally considered less risky than equities than in comparison to equities, as they involve contractual obligations and are often backed by the credit worthiness of the issuers. Now moving on to the key features of debt securities. So the first feature is fixed income. So debt securities typically provide a regular income, we can say, in the form of interest payment. These are also called coupons. So these payments are made at predefined intervals. Example, it can be annually or semi-annually and are generally fixed, making them a very stable source of return for investors. So if we understand this through an example, so example of fixed income can be example, a bond paying 7% interest annually will give rupees 70 on a rupees 1000 investment every year. In the same way, the second is maturity dates. The maturity date is the end date of the debt security life, and basically on this date the issuers repays the original amount, which is called face value, to the investors. And these debt securities can have short term, medium term or long term maturity period. For example, a 5-year bond issued in the current year 2025 will going to mature in 2030. So it will take the period of 5 years. Now the third rate is interest, or it is also called coupon rate. So this is the percentage of the face value which can be paid annually as interest to the investors, and it may be fixed. We can say that it is same rate throughout, or floating means which changes with the market rate. For example, a bond with a 6% coupon rate and rupees 1000 face value can pay rupees 60 every year. Now the next is face value. Face value is also known as par value. So the face value or par value is the original value of the bond that is returned to the investors at maturity, and interest is also calculated on the based on this amount only. Such as, if we take an example of face value, most bonds have a face value of rupees 1000 in India. Now the next one is market price. So the market price is the current trading price of the debt securities in the market, and it may be above premium, or if it is below, then it is the discounted value, the face value, depending on the interest rate and even the credit risk. For example, a bond with rupees 1000 face value might trade at rupees 950. It may be on discount, or it can be in 1050 depending on the demand. 1050 maybe it will be on the premium rate. Now let's discuss what are the types of debt securities. So the types of debt securities are: the first debt security is bond. Bonds are the long-term debt instruments issued by government or corporations. They pay a fixed interest called coupons at a very regular interval, and the principal amount is returned at maturity. For example, Government of India bonds or corporate bonds from companies like very prominent and very leading companies like Tata or Reliance. Second is debentures. Debentures are the type of unsecured bonds, which means these are not backed by physical assets. These are issued mainly by corporates to raise long term funds. And these are riskier than secured bonds, but often they have offer high interest rate. For example, these are non-convertible debentures (NCDs) issued by finance companies. Third one is treasury bill, T-bills. These are the short-term debt instrument which are issued by the government, usually up to 1 year, and these are issued at a discount and redeemed at face value, which means that no interest rate paid. For example, a treasury bill of rupees 1000 is issued at rupees 96, and it can be redeemed at rupees 100 after a period of time, that is 91 days. Now learners, we will discuss some benefits of debt securities. So the first benefit is it is stable and predictable return. So the debt securities provide a fixed interest income at regular interval, and these are ideal for investors seeking steady cash flow with very low risk compared to the equities. Second benefit is capital preservation, especially in when we see in the government or high rated bonds, the principal amount is returned at maturity, making them very safer. And these the capital preservation are suitable for conservative investors who prioritize security over very high rate of return. Now, the third benefit is diversification. If we talk about the diversification, it means including debt in a portfolio reduces the overall risk, as debt and equity market don't always move together, though they don't move simultaneously, and it balances aggressive investments with stable one. Now the fourth benefit is liquidity. It also provides liquidity. There are many debt instruments like government bonds or listed corporate bonds and tradable on exchanges. These provide liquidity, and investors can sell them in a secondary market if needed. Now there is also one more benefit, that it has a variety of options, like the investors can choose from variety of bonds or securities like government securities, or it can be corporate bonds, municipal bonds, debentures, commercial papers, and it's totally depend on, it's suited to different risk profiles and depends upon the duration also. Now learners, we will discuss who are the participants in the debt market. So the first prominent participant in the debt market are issuers. These are also known as borrowers. So it compromises government. Government means the central and state government, which issue treasury bills, government securities, municipal bonds. It also compromises corporates. It includes issue corporate bonds, debentures, or it can be commercial paper for raising funds. And it's one more is there, financial institutions. So in financial institutions it covers development banks, NBFCs, housing finance companies, issued bonds and debt instruments. Now the next participant in debt securities are investors. Investors are also known as lenders. So the investors comprises institutional investors like bank, insurance companies, pension funds, mutual funds, and it also includes retail investors, which means individual investors who are seeking a very fixed return with the lower risk. Third include Foreign institutional investors, FIIs, these invest to Indian government corporate bonds, and this basically subject to the Reserve Bank of India, or it can be with the SEBI norm, Security Exchange Board of India norms. Third, the participants is intermediaries. Intermediaries include primary dealers, stock exchange, brokers and dealers. So the primary dealers comprises which facilitates issuance and trading of government securities. Stock exchange means platform for trading debt securities, where we can trade through National Stock Exchange or Bombay Stock Exchange. And intermediaries also include brokers and dealers. Brokers and dealers means these enables transactions between buyer as well as sellers. So these are the prominent participants of debt security. Even one more is there is regulators and rating agencies, which comprises Reserve Bank of India, Security Exchange Board of India, and even the credit rating agencies. So if we talk about the Reserve Bank of India, this regulates government securities market, and on the other hand, the Securities and Exchange Board of India regulate corporate debt market. And finally, the credit rating agencies are ICRA, or it can be CARE or CRISIL. These credit worthiness of issuers. So these regulatory and rating agencies are also the participants of debt securities. So this is all in this lecture. In the next lecture, we will continue with the same topic, that is overview of debt securities.